Viewers at home, you are welcome to my presentation on cost volume profit analysis. Cost volume profit analysis or break-even analysis. If this is your first time of coming across my channel, or if you have not subscribed previously, please don't forget to click on the red subscribe button and turn on the notification bell icon so that you will be receiving a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. Cost volume profit analysis or break-even analysis. Break-even analysis is the study of the effects on future profit of changes in fixed cost, variable cost, sales price, quantity, and mix. The study of the effects on future profit of changes in fixed cost, variable cost, sales price, quantity, and mix is said to be the break-even analysis. Break-even analysis is the study of the effects on future profit of changes in fixed cost, variable cost, sales price, and quantity and mix. Break-even point is the level of activity at which there is neither profit nor loss. The level of activity at which there is neither profit nor loss is said to be the break-even point. At the break-even level, profit or loss equal to zero. At the break-even level, profit or loss equals to zero. Remember, profit is revenue less cost. Profit equal to revenue, that is sales, less total cost. That will give us the profit. Sales minus total cost, that is profit. And I've told you that at the break-even level, total revenue equals to total cost. At the break-even level, total revenue equals to total cost. If you bring this and this together, that means you'll be having total revenue minus total cost equals to zero. Total revenue minus total cost equals to zero. If total revenue minus total cost equals to zero, and I've told you that your total revenue, which is your sales, minus total cost, I said that is profit. That means if this is profit, that means profit will be zero. If this is profit, that is total revenue, that is sales, minus total cost, if it is zero, and the difference is profit, that is total revenue minus total cost is profit, that means profit equal to zero. Therefore, the profit will be zero at the break-even level, and losses too must be zero. Profit or loss equal to zero at the break-even level. Methods of calculating break-even. Methods of calculating break-even level or break-even point. Methods of calculating break-even point. There are two methods of calculating break-even point. Number one method is algebraic method. Algebraic method or formula method. Formula method. That is the first method. And my focus in this presentation should be on this first method. The second method is graphical method. Graphical method. This method shall be covered in another lecture. Graphical method. So I want to focus on algebraic method or formula method. So before I go into that, I want to define those terms which I'll be using in this topic or lecture. Definition of terms. Definition of terms. Number one is contribution. Contribution. So, if you have watched my presentation on marginal and absorption costing, I said contribution is sales less variable cost. Contribution is sales less variable cost. If contribution is sales minus variable cost, the word less mean minus. Sales minus variable cost, that is contribution. Sales minus variable cost is contribution. Number two, contribution margin per unit. Contribution margin per unit. Per unit. Which shall hitherto be abbreviated as CM. Contribution margin. It will hitherto be abbreviated as CM. Contribution margin per unit, that is selling price less unit variable cost. Selling price less unit variable cost. Selling price less unit variable cost. That is contribution margin. That is CM. That will be selling price to be abbreviated as SP minus VC, variable cost per unit. That will give us the contribution margin. Break-even level. I've told you that break-even level is the level at which there is neither profit nor loss. The third term I'm going to look at is contribution margin ratio. Number three, contribution margin ratio. Another word for contribution margin ratio. Contribution margin ratio will have to be abbreviated as CMR. Or if you don't want to call it contribution margin ratio, you can call it profit volume ratio. Profit volume ratio, which will be abbreviated as PV ratio, or CS ratio. CS ratio. CS ratio. That will be contribution over sales. Contribution over sales. That is CS ratio, contribution margin ratio. Contribution over sales. Then the next term, number 4, is margin of safety. Margin of safety. Margin of safety, which are highlighted to be abbreviated as MOS. This is the difference between the budgeted sales and the break-even level of activity. Margin of safety is the difference between the budgeted sales and the break-even level of activities. Margin of safety, budgeted sales minus break-even point. That is margin of safety. Number 5, margin of safety ratio. Margin of safety ratio. That will be budgeted sales minus break-even point over budgeted sales times 100. That is the margin of safety ratio. Margin of safety ratio. Then, having defined the major terms which are highlighted to be used in this presentation, I therefore want to give the formula that will be used in this lecture. I want to give the formula. After the formula, then we are going to solve questions as work example. As work example. So, break-even formula. Break-even formula. Break-even formula. Number 1, remember I've told you that contribution margin, CM, I said it is selling price less unit variable cost. Selling price less unit variable cost. That will give you the contribution margin. Number 2, I said contribution margin ratio, CMR, equal to contribution over sales, or you have the selling price less variable cost over selling price, or you may use the total. So if you use selling price less unit variable cost over selling price, or if you want to use total, it will be the total sales revenue less total variable cost over total sales revenue. So number 3, break-even point in unit. BP means break-even point. It is fixed cost over contribution margin. Fixed cost over contribution margin. I've told you that your contribution margin is selling price less unit variable cost. So, you know the difference between the selling price and the total sales revenue. Selling price is for a unit, the price for 1 unit of the product. Unit variable cost, that is the variable cost per unit. That will be considered here, not total. If you use total sales revenue and total variable cost, then you will still need to divide it by the number of units sold in order to get the contribution margin per unit. So, alternatively, just have selling price less unit variable cost. That will give us the contribution margin. To calculate the break-even point per unit, you have the fixed cost divided by contribution margin. You sum up all your fixed costs. You can have the fixed production overheads, fixed administrative overheads, fixed selling overheads. All the fixed costs should be aggregated. Number 4, you can have the BEP, break-even point of sales revenue, break-even point of sales revenue, that is in value, that is in dollar or in naira or whatever currency, the value. That will be fixed cost over CMR, contribution margin ratio. I've explained how to calculate contribution margin ratio above. Your contribution margin ratio. Anytime you want to calculate anything in unit, the denominator will be CM. And to calculate the value, the amount in value, that is in naira, in whatever currency you are given, or dollar, or pound sterling, or whatever currency, so the denominator becomes CMR. Number 5, number of units. Number of units to achieve a targeted profit. Number of units to achieve a targeted profit. That will be fixed cost plus targeted profit all over CM, because you want to determine the number of units. I've told you that to calculate anything in units, the denominator will be CM, but if it is value, then the denominator will be CMR. Number 6. Value of sales to achieve a targeted profit. Since it is value you need, the formula becomes fixed cost plus the targeted profit over CMR. Since it is value you need, the denominator will be CMR. Number 7. Number of units. 7. Number of units to achieve the profit after tax. Number of units to achieve the profit after tax. The formula will become fixed cost plus profit after tax. PAT means profit after tax, over 1 minus tax rate all over CM, which is contribution margin. Since it is units, you want to determine, that is why the denominator will be CM. Number 8. Value of sales or sales revenue. Value of sales to achieve the profit. After tax. Value of sales, that is in value. That will be fixed cost plus profit after tax over 1 minus tax rate all over CMR, since it is value unit. That is why the denominator becomes contribution margin ratio. So on this note, I want to take question as work example. Work example. The Agba Limited, a manufacturer of quality handmade pipes, handmade pipes has experienced a steady growth in its sales for the past 5 years. This question is obtained from Worker Performance Management by Ade Omolehinwa. Agba Limited, a manufacturer of quality handmade pipes, has experienced a steady growth in its sales for the past 5 years. Increased competition, however, has led Mr. Agba Limited CEO to believe that an aggressive advertising campaign will be necessary next year to maintain the company's present growth. To prepare for next year advertising campaign, the accountant presents Agba Limited with the following data for the current year 19A. You have the cost schedule. Cost schedule for Agba Limited is given. So you have the variable cost, which comprises direct labor of $8, direct materials of $3.25, variable factory overheads of $2.5. The total variable cost is $13.75. This is per pipe, for one pipe. So it's naira. The currency is in naira. You have the fixed cost. Fixed cost, which comprises manufacturing of 25,000 naira, marketing of 40,000, administrative of 70,000. The total fixed cost is 135,000 naira. Then you have selling price per pipe, 25 naira. Expected sales 19A is 20,000 units at 500,000 naira. The value is 500,000 naira. Then income tax rate is 40%. Then Mr. Agba Limited has set the 19B sales target at a level of 550,000 naira or 22,000 pipes required. A. The projected after tax net income for 19A. This is projected after tax net income. So if you want to prepare you want to calculate the after tax net income, that means you are expected to prepare the income statement for 19A. Then B, the break-even point in units for 19A. You want to calculate the break-even point in units. C, the after tax net income for 19B. After tax net income, this is net income that is required also. So that means you are expected to prepare income statement for 19B. If an additional fixed marketing expenses of 11,250 is spent for advertising in 19B, with all other costs remaining constant, in order to attain the 19B, in order to attain the 19B sales target. In order to attain the 19B sales target. D, the break-even point in naira for 19B. If the additional 11,250 is spent, is spent for advertising, then E, the required sales level in naira sales to equal 19A's after sales net income if the additional 11,250 is spent for advertising in 19B. F. The maximum amount that can be spent on additional advertising at a sales level of 22,000 units if an after tax net income of 60,000 naira is desired. G. The sales required in units, assuming the additional 11,250 naira is spent for advertising and a profit after tax of 12% on sales revenue is required. That is the question. Solution. For our purpose, no, the question is for Agba Limited. Solution. Agba Limited. For our purpose, let's first of all determine the contribution margin. CM. Contribution margin, which is CM. Remember, I've told you that CM is selling price less unit variable cost. Selling price less unit variable cost. Now, the selling price is given. The selling price is given to be 25 naira per pipe. You were told selling price per pipe is 25 naira. So if the selling price is 25 naira and the unit variable cost from the cost schedule, variable cost, total variable cost is per pipe and is 13.75. Therefore, contribution margin will be selling price minus the variable cost. So our selling price is 25 naira. 25 naira minus unit variable cost, which is 13.75. Therefore, CM, that is contribution margin, 25 naira minus 13.75. Then we have 11.25 naira. 11.25 naira. So we can equally compute the CMR, contribution margin ratio. Contribution margin ratio, or CS ratio, which is contribution over sales. You can use contribution, the total contribution, or unit contribution, contribution margin over. If you use total contribution, this will be the total sales revenue. If you use contribution margin, that is contribution per unit, then this will be selling price. And our contribution margin is 11.25, that is selling price minus unit variable cost. So we have 11.25 divided by the selling price. Our selling price is 25 naira. Therefore, the contribution margin ratio will be 11.25 divided by 25, and we have 0.45. 0.45. Now, we have determined the CM, contribution margin ratio. Now, we want to solve the requirement A. The requirement A. The projected after tax. The projected after tax net income for 19A. I've told you that to solve this, you are going to prepare the income statement. Now, let's prepare the income statement for 19A. 19A, that is Agba Limited income statement for 19A. Your income statement used to start with sales or revenue. Revenue. And how much is the revenue from 19A? The revenue from 19A, expected sales, 19A, 20,000 units, and the value is 500,000. That means the revenue from 19A is 500,000. 500,000. So from revenue less total variable cost. Let's total variable cost. You were given the variable cost per unit of 19A. The variable cost per pipe of 19A is 13.75. Multiplied by the number of units of 19A sold, which is given to be 20,000 units. So we have 13.75 times 20,000. 13.75, that is the variable cost per unit, multiplied by the number of units sold, which is 20,000. That will give you the total variable cost for 19A. 20,000 times 13.75, then we have 275,000. 275,000. That is the total variable cost from 19A. When you less the total variable cost from the total sales revenue of 500 minus variable cost of 275,000, then you have the difference of 225,000. 225,000. That is the total contribution. Total contribution. The total contribution from 19A is 225,000. From contribution, we less total fixed cost. You less total fixed cost. And how much is the total fixed cost of 19A? The total fixed cost is given to be 135,000 naira. That is the total fixed cost. You were told fixed cost. So these are the makeup of the fixed cost. The total is 135,000. So the total fixed cost is 135,000. When you subtract 135,000 from 225,000, then you'll be left with 90,000. This 90,000 represents profit before tax. Profit before tax. If you go back to the requirement A, what you have to calculate is the projected after tax. That means what you need is the profit after tax, not profit before tax. The projected after tax net income for 19A. What you need is the profit after tax. And you are given the tax rate. The tax rate is given to be 40%. Income tax rate is 40%. So that means you will need to calculate the amount of tax payable for 19A. The amount of tax payable for 19A. So we have income tax. Income tax, which is 40% tax rate, multiplied by the 90,000, which is your profit before tax. When you calculate 40% of 90,000, then you have 36,000. 36,000. If you subtract 36,000 from 90,000, then you'll be left with 54,000. 54,000. That is profit after tax. That is the requirement A, where you have to calculate the projected after tax net income for 19A. Now, B, the requirement B. Now let's go back to the question. Requirement B. The breakable point in unit for 19A. The breakable point in unit for 19A. I've told you that to calculate the breakable point in unit, you have break even point in unit. I've told you that it is fixed cost over contribution margin, which is CM, since it is unit. Our fixed cost is given to be 135,000 naira. So if the fixed cost is 135,000 naira, 135,000 over contribution margin, CM. Our CM has been calculated above. Contribution margin CM, which is 11.25. So if our CM is 11.25, then you have over 11.25. So 135,000 divided by 11.25, then we have 12,000 units. 12,000 units. Therefore, break even point is 12,000 units. B has been answered. Then back to the requirement C. Requirement C. In the C aspect of the question, you were told that the after tax, you have to calculate the after tax net income for 19B. After tax net income for 19B. After tax net income for 19B. If an additional fixed marketing expenses of 11,250 is spent for advertising in 19B, with all other costs remaining constant in order to attain the 19B sales target. Since it is after tax net income you have to calculate, that means you prepare income statement for 19B. Now let's have the income statement. Income statement. So Agba Limited. Agba Limited. Then we have Agba Limited income statement for 19B. Remember, you were told that an additional fixed marketing expenses of 11,250 will be incurred. So you have your revenue. Revenue. How much is the sales revenue from 19B? Sales revenue from 19B. You were told Mr. Agba Limited set the 19B sales target at a level of 550,000 or 22,000 pipes. The revenue is 550,000, the number of units is 22,000 pipes. So take note of that. So we now have your revenue 550,000. 550,000. From there we less total variable cost. So we less total variable cost. Your variable cost per unit. You know the number of units sold now for 19B is 22,000 units. 22,000 units multiplied by the variable cost per unit. The variable cost per unit is 13.75. So 22,000 times 13.75. So that will give us, we have 22,000 times 13.75. We have 302,500. 302,500. So when you less that from 550,000, then that will give us 247,500. That is total contribution. From total contribution, you less total fixed cost. Less total fixed cost. The total fixed cost still remain 135,000. 135,000. Fixed cost total is 135,000. So we have 135,000. So when you less 135,000 from 247,500, then you'll be left with 112,500. This is profit before tax. Profit before tax. You now less total fixed cost. Your total fixed cost, we have deducted the fixed cost. So our fixed cost, initial fixed cost was 135,000. 135,000. Then you were told in the requirement C that the after tax net income, in requirement C, you are to calculate the after tax net income for 19B. If an additional fixed marketing expenses of 11,250 is spent for advertising in 19B, with all other costs remaining constant in order to attain the 19B sales target. So the only thing that changed here is the fixed marketing expenses. That means in addition to 135,000, then you will also incur fixed marketing expenses. Marketing expenses of 11,250. 11,250. When you add it to 135,000, 135,000 plus 11,250, that means the fixed cost become 146,250. 146,250. When you now less 146,250 from 247,500 minus 247,500, then you have 101,250. That is our profit before tax. Profit before tax. Then you now have income tax at 40% tax rate. 40% of 101,250. 40% of 101,250. That will be 40,500. That is our tax. 40,500. If you now less 40,500 from 101,250, then the net difference will be 60,750. That is profit after tax. Profit after tax. So that is requirement C. Requirement C. Then D now. Requirement D. So back to the question. In the requirement D, you have to calculate the break-even point in Naira for 19B. If the additional 11,250 is spent for advertising, you have to calculate the break-even point in Naira. The break-even point in Naira for 19B. For 19B, if the additional 11,250 is spent for advertising, that is the requirement D. You want to calculate the break-even point in Naira. So BP in Naira. So that is requirement D. D now. So we want to calculate break-even point in Naira. I told you that the formula for calculating break-even point in Naira, I said it is fixed cost. Since it is in Naira, that is in sales value, the denominator becomes CMR. Fixed cost over CMR. The only changes to the existing fixed cost is the additional 11,250 spent on advertising. So you know the existing fixed cost of 19A is 135,000. So our fixed cost 135,000 plus 11,250, which will be spent in advertising as given in the question. The 11,250 that will be spent on advertising. So that means the total fixed cost will be 135,000 plus 11,250. Then you have 146,250 naira. 146,250. So the breakable point now, our fixed cost is 146,250 over CMR. Our contribution margin ratio CMR is 0.45 as calculated earlier. So we have divided by 0.45. Divided by 0.45, then we have 325,000 naira. 325,000 naira. So the breakable point in naira, therefore, break even point in naira for 19B will be 325,000 naira. That is the breakable point in naira. That is requirement D. So we want to look at the requirement E now. The requirement E. Back to the question. E. The required sales level in naira. The required sales level in naira. In naira sales. The required sales level in naira sales to equal 19A after tax net income. If the additional 11,250 is spent for advertising in 19B. This is not an income statement. The required sales in naira. That means the break-even point in naira. The value of sales to equal 19A after tax net income. So your targeted profit is 19A after tax net income. So you want to achieve the 19A after tax net income. I think that was in requirement A. So you know in requirement A of the question, you have to calculate the projected after tax net income for 19A. So the net income, that is the profit after tax you get here. So you have to calculate the amount of sales, that is the sales value that will give that profit after tax of 19A for 19B. You want to calculate the sales value for 19B that will give us the after tax net income of 19A if you spend additional 11,250 for advertising in 19B. So that is value of sales to achieve the profit after tax. Value of sales to achieve the profit after tax. Profit after tax. The formula is fixed cost plus profit after tax over 1 minus tax rate all over CMR. Since it is value of sales unit, the denominator will be CMR. So if you spend additional 11,250 on advertising in 19B, that means the total fixed cost of 19B becomes 146,250. So the fixed cost is 146,250. That is our fixed cost plus the profit after tax. So when we solved the A aspect of the question, what was our profit after tax from the requirement A? We got 54,000. 54,000 as our profit after tax. That is requirement A. The solution to A aspect of the question, we have 54,000 as the profit after tax over 1 minus tax rate. And our tax rate remain 40%, 0.4, all over, since it is value unit. So the denominator is CMR. And our CMR is 0.45. So all over is 0.45. 0.45. So this will be 146,250 plus 54,000 over 1 minus 0.4 will be 0.6. Everything over 0.45. So you divide 54,000 by 0.6. 54,000 divided by 0.6, we got 90,000. This is 90,000. 54,000 divided by 0.6. 90,000 plus 146,250. The total of the numerator is 236,250. 236,250 divided by 0.45. Divided by 0.45. So we have 525,000 naira. So the answer is 525,000 naira. So the required sales level in naira for 19B to give an after-tax net income of 19A is 525,000 naira. So we want to take the F aspect of the question. The F aspect of the question. The maximum amount that can be spent on additional advertising. The maximum amount that can be spent on additional advertising at a sales level of 22,000 units. At a sales level of 22,000 units. If an after-tax net income of 60,000 is desired, the after-tax net income of 60,000 is desired. Now, we want to answer that. You are given the profit after tax of 60,000. Profit after tax is given to be 60,000. Our part, that is requirement F. Our part, profit after tax, is given to be 60,000 naira. The maximum amount that can be spent on additional advertising at a sales level of 22,000. Number of units to achieve an after tax profit is given to be 22,000 units. That is, you want to sell 22,000 units in order to achieve the profit after tax of 60,000. F. The maximum amount that can be spent on additional advertising. Remember, advertising expenses is a fixed cost. Your profit target is 60,000, and that is your desired profit. So you want to calculate the additional amount that will be spent on advertising. So your fixed cost, your existing fixed cost is 135,000 naira. That is our existing fixed cost. Tax rate. Our tax rate still remain 40%. Our tax rate still remains 40%. So you are to determine the maximum amount. The maximum amount that can be spent on additional advertising. Let that amount be X. Let the maximum amount that can be spent on advert be X. Let the maximum amount that can be spent on advertising be X. And remember, advertising is part of the fixed cost. That means our new fixed cost now, new fixed cost will now be existing one, which is 135,000 plus advertising expenses of X. That is what we have to calculate. So you want to look for the value of X. You want to look for the value of X. And you have been given the number of units that can be sold to achieve after-tax profit. Number of units to achieve an after-tax profit. The formula is fixed cost plus profit after tax over 1 minus tax rate. 1 minus tax rate all over CM. Why using CM? Why not CMR? Because this is in units, not value. Number of units to achieve an after-tax profit is what we are given, not the value. So our fixed cost now is 135,000 plus X. 135,000 plus X. That is our new fixed cost. 135,000 plus X plus profit after tax. And our profit after tax is given to be 60,000 naira. We have plus 60,000 naira over 1 minus tax rate, which is 0.4. All over CM. Our CM contribution margin, which had been calculated earlier, and we got 11.25. 11.25. 11.25. Remember, it is the number of units to achieve an after-tax profit that will give us this. And that unit has been given to be 22,000. That means 22,000 units is equals to this. Since that number of units has been given. So, you want to solve for X. You want to solve for X. X is the unknown variable in the formula. So, you therefore want to solve for X. So, we still have 22,000 equals to 22,000 equals to 135,000 plus X. 1 equal to 135,000 plus X plus 60,000 divided by 1 minus 0.4 will give us 0.6. 60,000 divided by 0.6, and that will give us 100,000 plus all this one gives us 100,000 plus 100,000 plus 100,000 all over the denominator is 11.25. 11.25. 11.25. So that means you have 22,000 equals to, if you have 135,000 plus 100,000, that will be 235,000 plus X over 11.25. So when you have a problem like this, you cross multiply. 22,000 times 11.25, that gives us 247,500. When you cross multiply, this times this equals to the numerator, equals to 235,000 plus X. So make X the subject of the formula. You have X equals to 247 12,500. When you bring this one to join it at the left hand, this is plus, it becomes minus 235,000. Therefore, x equals to minus 235,000. X is 12,500. So, the maximum amount based on the requirement F, the maximum amount that can be spent on additional advertising at a sales level of 22,000 if an after-tax net income of 60,000 is desired is 12,500. So that is the maximum amount that can be spent on advert. So the maximum amount that can be spent on advert at a sales target of 22,000 units to achieve an after-tax profit of 60,000 is 12,500. That is the requirement F. Finally, the requirement G. So this is part 1. So the part 2 shall cover the break-even in a multi-product company. Break-even in a multi-product company or multi-product break-even analysis. Now, requirement G. The sales required in units, assuming an additional 11,250 is spent for advertising and the profit after tax of 12% on sales revenue is required. Profit after tax of 12% of sales revenue is what is required. That is G. And that sales revenue is different from budgeted sales. The sales you are given in the question of 500,000 for 19A and 550,000 for 19B are the budgeted sales, not the sales for the next period. No, you want to estimate what the sales revenue will be for the next period, and we don't know that. The sales required in units, that means it is the number of units to be sold that you need. Assuming an additional 11,250 is spent for advertising and a profit after tax of 12% on sales revenue is required. So now, what is our sales revenue? We don't know. Let the sales revenue let the number of units to be sold. Number of units to be sold be X. Therefore, the next year revenue, this is the number of units to be sold next year. So the next year's revenue, if the selling price remains 25 naira as given earlier, times the number of units, that means you have 25x naira. That will be the sales revenue for next year. Now, and the profit after tax desired is 12% of sales revenue. Profit after tax of 12% of sales revenue is desired. So part now will be 12% of sales revenue, which is 25x. 12% of 25x. Then we have 3x. That is our desired profit after tax. Now, number of units to achieve an after-tax profit. That is what is expected of us to use. The number of units to achieve an after-tax profit. The sales required in units. That is number of units in order to achieve an after-tax profit. So the formula is number of units to achieve an after-tax profit will be fixed cost plus profit after tax over 1 minus tax rate all over CM, because it is units. You were told that 11,250 will be spent on advertising. Remember, the existing fixed cost is 135,000. If you now spend 11,250 on advertising, then your fixed cost become 146,250. You have 146,250 plus the profit after tax, which have been calculated to be 3x. 3x over 1 minus tax rate. Tax rate is 40%. All over CM. CM is 11.25 as calculated earlier. That number of units is what we are looking for. It's not given, so it's x. That means x equals to this. Then you make x the subject of the formula. If you cross multiply x times 11.25, then you have 11.25x. 11.25x equal to 146,250 plus, no, I have multiplied this by this, equals to this. This plus this. So 3x divided by 0.6. 3x divided by 0.6 will give us 5x. So to solve for x now, you collect the like terms. You have 11.25x minus 5x equal to 146,250. So when you subtract this, you have 6.25x equal to 146,250. To get the value of x, you divide both sides by 6.25. So our x will be 146,250 divided by 6.25. So 146,250 divided by 6.25, then we have 23,400 units. The sales required in units is 23,400 units. So that is the answer to the G aspect of the question. Please, this is part 1. Part 2 shall cover the break-even point for the multi-product company. Break-even point for the multi-product company. If you have not subscribed previously, please don't forget to click on the red subscribe button and also enable the bell notification icon so that you'll be receiving a notification message each time I drop a new video. Thanks.